Hello, I'm Steve Bell, Chairman and CEO of Tennessee Bank and Trust. We are a privately owned bank with offices in Cool Springs and Green Hills. We are a business that happens to be a bank, and our customers tell us the difference is clear.
Warren Buffett's got a line that he says to people whose businesses he acquires. He said, you know, when we have this closing, the only thing that's going to change for you is you think you're getting rich in this closing. You're not. You're just changing the form of your wealth. Mm-hmm. Before we had this closing, you had most of your net worth tied up in a business, many of them started by you and your family. And what you have on the backside of this closing is a big pile of money that you really don't know anything about what to do with that. So, you know.
Well, that's scary.
Yeah, it's a little scary. The game changes. So I think to think about it as an exit is it leads you down some roads that, although you know we do certainly financial. We're a financial buyer when we invest in things. We're not planning to be in them forever. But I do think that if your mindset is that you might be in them forever, that helps channel some of your decisions in an interesting and appropriate way. Where all that leads me is, yes, it's smart to begin with the end in mind, but don't obsess about it. What is important is to build a good business. If you build a good business, you will have exit options. If you build a business that generates cash, if you build a great team that's deep so that everything doesn't depend on you, you'll have a better exit if you're not focused on an exit. And when early stage companies come in and talk to us about investing in them, I like the ones that want to change the world. You know, I want to build a great business. The ones who come in and say, you know, we want to do these three things, and then we think Google will want to buy us for $1 billion. It happens, but I'm not sure that that's the best approach. So build a great business, and then you've got options. Have good advisors on hand, and you've got options. And remember, it's not really an exit. The game just changes, you know. I mean, maybe what you do on the backside is just spend the rest of your life spending the money or giving it away. That's not awful, but probably what happens is you do something else, and you got to think about that.
Well, maybe. Kind of depends on where you are in your life cycle and your family cycle.
Yeah, it depends on where you are.
But I want to talk a little bit about the emotional and the personal side of owning a business that you have grown and nurtured. And can you talk a little bit about your experience?
Well, I don't have my ego in my business, and that makes it a little easier. I love what I do. I love the business. I love running the company. I now love having other people primarily running the company. I don't want them to do things the way I've done it. I don't feel that I think we've built a great brand, we've had a profitable business, we have a good reputation, and those are the things that I think make them more interested in having the company. But I'm counting on them, and I see what they're doing to make it better, because there are so many different stages of a business, just like there are different stages of life. Mm-hmm. And so I'm not I had somebody advise me one time who said, when you get ready to turn your business over, whether you sell it, you know, there are a lot of options, or have family or whatever, get out of the way. And actually, I've been very surprised that that's been pretty easy for me to do.
Do you mind me asking, are you letting them buy you out of the business? Let's talk a little bit about structure. Well,
I've structured it a little differently than I would if it were an arm's length stranger buyer. A lot of situations in a small business, that is the asset that somebody has. Fortunately, that's not my only asset, so I can look at it perhaps a little differently. And I've structured them a deal where I have an ongoing income for a number of years, and they ultimately have paid off at least over half the business.
Right.
So that's working really well.
So you will get out, and the end game is whenever that winds down, you'll be gone. They'll be 100% in.
Yes.
Yeah. So Richard, does that sound like a good plan to you? You've done the big kinds of deals with IPO, roll-up and IPOs, but have you had any experience with just sort of easing your way out of the business and kind of being half in, half out, and then but trying to let go?
Not at all. With me, there's sort of a bright line kind of exit.
That sounds so sweet to me. I mean, just to figure it out to where there's a line.
The thing about a bright line exit that I speak of that I learned the hard way is, there are different forms of consideration. There's cash. I got stock 2 times that wound up not being worth nearly what I thought it would be worth. So I would recommend that people do a lot of due diligence on the purchaser itself. If it's not a cash purchase where you go put money in the bank, then be cautious, because there may be a lockup period of 6 months, and the world can change dramatically. I had millions and millions of dollars worth of stock that became worth 0 in the .com burst. So
not fun.
Take some money off the table at the point in the transaction, and be very wary as to the form of consideration that you're getting for your purchase.
There are stories in my family where they could have gotten $1 million worth of Shoney stock in 1972, but wanted folding money, as they said, and I said, this is my wife's family, and I said to her, if they'd taken the Shoney stock, we could be on the beach now.
Well, a lot of people who own businesses aren't financial people, really. I mean, there are a lot of small businesses that are very successful. They're not financial. So, what kind of advisors do they get? Let's talk about how you get support to determine the value of your company and how you structure your deal.
Well, I had a background in investment banking, so I kind of knew enough to be a little dangerous when we started thinking about valuation. My husband and I are co-owners. We did seek the counsel of a former colleague of mine who had a practice in investment banking, specifically within the construction industry. He's dealing day to day with construction businesses and then strategic buyers, private equity firms basically. And he knows more, what are the cash flow multiples. My husband and I had a sense for the potential buyers we wanted to go to, and we probably had 6 or 7 ideas. Aaron was able to help us come up with about 20 very targeted companies to go to, and so that helped us define our process. I think the other thing that advisors can help you do is, talking about consideration, talking about the structure of a deal. I was a little out of touch of, what are reps and warrants now that people want? What's going to go on with indemnification? And once you understand the concepts, they're not all that complicated, but, if you're not in it, you don't know the questions to ask.
Right. And there are a lot of questions to ask.
There's a lot of questions to ask, and there's also tax considerations. So we had our, we knew enough to ask about that, and, do you want to sell assets or equity, and what's involved with all that? And so, between we did use an investment banker, we used a lawyer, and he had helped us buy the company, and he was a corporate securities attorney that we had worked with before. And then we had our tax advisor that helped us quite a bit. They all knew each other as well, so we could have some pretty good conversations with the three, between all the parties.
But other than maybe the investment banker, you had pre-existing relationships with the other advisors.
That's correct. That's correct.
To my mind, a danger is when if you don't cultivate those sorts of relationships, then pretty much everybody you get around you is going to get paid basically out of the transaction, and that everybody has fiduciary duties, but follow the money is not a bad rule.
Right.
It's going to potentially shade the advice, and so I think I mentioned it earlier that if you build that network of advisors around you as you build the business, if they're good, they'll help you build the business. They're not just good advisors for the end game; they're good advisors along the way. And they know the business, and they can give you the sort of guidance that you got.
I couldn't emphasize that anymore. I mean, my attorney, who's does a lot of real estate work. I don't think it. I think you should have somebody that legal help who knows that kind of business very well. And our tax CPA have been part of my team since before, in the founding of the company, and on an ongoing basis, so that when you get to the point of any exit situations, they're already part of the team. And the important thing is that the trust has been built up over the years.
Sure.
In terms of the actual, if you sell a company, then I think you need somebody that's familiar with, does a lot of M&As, mergers and acquisitions, and that's their specialty.
So I want to ask you all a question. My company has my company name on it, Lovell Communications. At some point, I don't want to, just plant a flower on my head and still be sitting there when I'm when I'm gone. So, what about my name? Should I consider saying, okay, you can have the name as long as these people are involved, but once you get somebody else who I don't know, then you have to give up the name? How would you all recommend that I manage that? Because it's a big asset in our business. We got clients in every state; they know the name, but also it's my name. And if I'm not going to be there to protect it and manage the quality, keep in mind I'm a small business owner. It's my baby. I grew it. I want the quality to always be there because it's got my name on it. What should I do?
I think a lot of the value in your case is in the name, and if you don't sell the brand, you're going to get a lower value for it.
And I think that it gets down to what's more important to you, getting more money for your business, or getting less, making those choices and not taking the risk. I think it's a risk evaluation.
Yeah, well, I'm told I'm quite the risk taker. I don't believe it, but I think I know what I'm going to do.
Paula, one thing that I encountered was it can be very hard to sell this. Harder than I thought. We had bought a couple of small businesses, and those seemed to be fairly easy. And my partner and I had this small retail business, and we expanded every 3 or 5 years, and we opened a store out of town and bought a store here too. So we sort of grown, and we were in our late 50s, and our game plan was, have jobs that we liked and make some money and take care of our kids, and in 15 or 20 years we'd figure out what to do. And what to do is probably sell it to somebody. My partner was in an elevator accident in New York, and she was injured pretty dramatically. So instead of expanding every 3 or 4 or 5 years, we had to start contracting. And then it became clear at some point we really need to sell it. And it wound up taking us an incredible amount of time, distracted a lot from our business. And we had bought 2 or 3, and that seemed to be fairly easy and go smoothly. Selling what we had took 5 times as much as buying it. So I would say somebody needs to be prepared in case, like in our situation, things change on the ground and you've got to go to plan B. And then I would say, unless you're very fortunate, it will probably take more time and effort than you ever dreamed it would.
Yeah.
I think the average time for a small business sale is 2 to 4 years, so be prepared for that. If you can at all possible, sell out of strength versus weakness. I would say be reasonable and fair on your price. And expect, as a small business person, expect seller finance some, if not most, of the purchase. And as you're doing all that, keep very good records, be it QuickBooks, be it audits, be it whatever the case may be, from vendors to payables to whatever the case may be as far as that works out. Because it's a difficult type thing. We ended up selling out to 2 department managers. And just a little off of that, of course, they didn't necessarily have the wherewithal. They had the experience and they knew what they were doing. They could run the business and the customers liked them. So to make it more palatable to them, I took some of the hard assets out, which they would need to finance, to lower the pie, to small the pie and lower the price. And then did a phase 2. I kept those and then did longer term lease purchases, be it the real estate, be it some machinery, and then they phased into that, which made it work for both sides.
Dan, what you're saying, the list that you offered, which were great pieces of advice, it's a second job. It's a full-time second job to go into the process of starting to sell your business. And I think it can be overwhelming. I agree with Roddy that, boy, it was a lot easier for me to start my business, probably because I was naive. I didn't know, I just thought, well, I know how to do what I'm doing, so I'm just going to keep doing it and put a name on it, right? Who knew? But selling it is a different matter.
Selling a business has a lot in common with just selling a house. I mean, there are metrics for a piece of real estate. There are metrics for valuing real estate. There are metrics for valuing businesses. They're not the same thing, but price per square foot, price, earnings, same basic concept. And my observation about a lot of people selling houses is they get stars in their eyes about valuation. They want to hang a big number on it, and then the sign stays there in the yard for a long time. And ultimately, they get less than they maybe could have if they had put a sensible price on it on the front end. So I think that gets to having good advisors, having them involved over time, so that you've got a good relationship with them, having good systems, and then price it fairly.
Could I get an excerpt of what he said about pricing houses fairly? And use that as part of our branding?
There's an element, it's funny people talking about getting emotionally attached
Because
to
that is
businesses.
so true and so
People get
typical.
emotionally attached to houses too.
I think every situation is unique. There's not one size
I do
fits
too.
all. But I think it's really important, the point you brought up earlier, Paula, is that you're emotionally ready to do it. It's something that's right for this time of your life, and that you have a circumstance that you're going to be comfortable with.
Right.
I think following Town's point about metrics, I think it's fairly critical to understand how your business is going to be valued in order to be able to exit, because every market segment or industry segment is valued differently. Sometimes companies are valued purely on cash flow. Sometimes your intellectual property is being acquired. Sometimes the base of operations, just for a company to have an operating base. Sometimes you're being acquired for number of customers, or for page views to a website, or for talent. Sometimes a company's been acquired just to get their
The acqui-hire.
their engineers.
Or for reputation. I mean, I wish there were
Or for
some
brand.
metric.
Or for brand.
It's hard to measure the brand
So-
equity.
And at the end of the day, I think that's right. And certainly you see these businesses that, so this business is valued at so much per subscriber or something
Right.
like that. Ultimately, I tell myself, and then I look around and see some of what looks like insanity to me that happens in the marketplace, but ultimately, I want to say, all those metrics are ultimately a proxy for cash. A business ought to be worth, the net present value of the cash it can deliver to the owners over time. There are times when that relationship seems, in some industries, to get very attenuated, and I think, to be savvy is to be aware of that and to try to, you ought to be building your business to make it a good business, and then, at the same time, recognize, as you say, how's it going to be valued in the marketplace, and let's try to have some of what the marketplace appears to be buying.
And growing your people so that they can take your place and bring that value.
Building a team. That's part of building a good business, is build a good team.
Oh, absolutely. And I always say, it doesn't make any difference that my name is on the door, because the people who are running the business and have been for the last 5 or 8 years, and the strength of the company is in those people who have been working there and who don't have the same name.
I'm not sure that I could probably come up with an example of this, Paul, but to your point about worrying about your name 10 years, after you sold the business, one thing you could think about doing is before as you think about selling, maybe change the name and gradually sort of move the brand. It's
I think so,
expensive.
too. You have
It's
time.
expensive.
You can
But, Esso turned into Exxon.
Right.
It didn't seem to get any smaller.
Well, if I
Well,
had that
again,
kind
I
of
think
funding,
that
I'd
goes-
definitely do it.
That goes back to the value of the name and how much the owner's willing to on the compensation that you're going to get
Right,
for
and
that
that's a
name.
very expensive deal to
Yes,
change
it
a
is.
name.
No,
You
it
do
is.
it well.
It
You
is.
can
No,
do
it
it.
is.
You can do it cheap for 5 years, or you can do it like you should do it and do it in 6 months to a year, and it'll cost you a fortune.
That's a fair point.
And that does eat
So it
away.
all does
That
all-
eats away at a small business.
It ultimately comes down to a financial calculation, really, which is sort of the point you made earlier.
Exactly. So what are some of the mistakes that you've heard out there?
One mistake I heard recently, which was interesting, was that someone who sold a business but stayed in the business found that his people or her people would go around the new owners and come to the previous owner with issues.
Oh.
And they would respond to that. And I think that proved to be a huge mistake. If you turn it over, you're not the decision maker anymore, and you need to redirect those people who were your people. It's hard to do, probably. You have to redirect them to the new decision makers.
So do you still have an office in your office? You still go in every day? You still?
Do I go in every day? I go in about 4 days a week. Not for
So she's not
for the whole
working
day.
80 hours a week anymore. She's got
That's
it down to
right.
40 hours a week.
Well, not quite, but when they ask me to come, part of managers' meetings, we have owners' meetings, and those sorts of things, and I come in and I do what I do, and if they ask me to sit down and they want to bring me up to date on some things or get my opinion on some things, I'm available, but not obtrusive.
The point y'all made about the time it takes to do this made me think of something else in terms of mistakes that people make. And I'm a broken record on this, but if you build good systems and you've got good records, then I think it makes it a lot easier to handle this process with a very narrow team, that you don't have to involve tons of people in the business in the process until it's very advanced. And I think that's ideal, because something that is just it's an issue with a major capital raise, major financial transactions that take management's eye off the ball. They just necessarily do, because it's, you're already working 10, 12, 15, 16 hours a day, and now you get this second job of raising money, doing a big capital raise, negotiating a big bank line with anybody, Tennessee Bank and Trust are very easy to deal with. But
There you go.
Your rate stays the same thing.
Right, good. It's product placement there. But, any kind of major financial transaction is a huge distraction to management, and you see it all the time, that, you look back and you say, well, what happened there, that big dip? Well, we thought we were trying to sell the business, and then we didn't, and in the meantime, we hadn't paid enough attention to the business, and things kind of got off the rails, and it took us a while to recover. So there's no way to avoid that issue completely, but if you're structured in such a way and you've done the things right, and you can keep the number of distracted people as small as possible, then hopefully you've built a team who can keep the wheels turning while you're distracted, but where the senior management's distracted by this major financial transaction. But it's really, in our business, we say we invest with an owner's mindset, and we're structured so that we don't have any calendar-driven reasons that we have to sell, like our fund's going to run out or anything. But still, for the most part, you buy them, you grow them, you sell them. That's the nature of the business.
One thing that, in our specific case, is a lot of these examples we've heard, there's probably a pretty good universe of potential buyers. In the business we had, there was really a small universe of people that would even be interested or able to do that. Because the problem we had is we were a little bit bigger than a mom and pop, and our stores were bigger than that. And after we did the research and did some examination, there was a really short list of people that would have an interest and have the capacity, and that we'd feel comfortable, as Dan said, holding some sort of note from them. And that really made us get pretty real about the price we had, because the businesses were pretty decent, but the universe of people that really would find that attractive and it would work for them was really limited.
So any final words, Beth? If we each had to advise somebody on with small business, let's kind of keep it to small business, what's the thing you should be thinking about?
I think the word that pops into my head, and I've heard it repeated throughout everybody's comments, is I think when you are thinking about your business, you have to be reasonable and you have to be realistic. I can't tell you, in the couple of years we were looking to buy businesses, we would sit down with a business owner and he would say, I want $2 million for my business. And we would say, well, gosh, we've kind of looked at it and run the numbers and it's really worth about $1 million. Well, I need $2 million to retire, but your business is worth $1 million. It's just a complete flyby.
Right.
That goes back to the homeowner.
Yeah.
Sure, it's the same
I need so-and-so to buy
I
this
need to
house.
sell this house for $1 million
Yes.
so that I can accomplish some end of
Buyer's not
mine. The buyer
interested in
doesn't
that.
care.
The buyer really does not care. And
Yeah.
so I think then when you're on the flip side and you're the seller, you need to understand, what is my business really worth? What buyers are out there? What are they capable of? You kind of have to take a grown-up kind of perspective of it, not just say, I want to get what I want, I need what I need. And I think likewise, you also have to look at your own business and say, what are the strengths and what are the weaknesses? What have I built here? What have we accomplished? And you really have to look at it from a buyer standpoint so that you know how to negotiate, and perhaps maybe if you're a couple years out from selling your own business, say, well, gosh, that's something maybe I need to shore up, and let's spend a couple years rebuilding my IT department or protecting my intellectual property or whatever it needs to be. You know, and that just goes back to be realistic and be reasonable, and make it a win-win transaction, because nobody's going to buy your business if they're on the losing end.
Shirley, comment?
Well, I'd add another R to the reasonable and realistic, and that's be ready. You know, because I think sometimes you can, a situation arises or presents itself, and you pursue it, but you're really not ready to do that, whether it's emotionally, financially, time of your life, or whatever. And then when you have your mindset that you're ready, and this is really what you want to do now, then get it done and get out of the way, be supportive to the new owners, but realize that you are not in the driver's seat anymore.
Richard, thoughts?
You know, my advice would be to identify the advisors that circulate within your vertical market. Every vertical has one or two people that knows all the players, and if you identify those people and build a relationship with them, when it comes time to sell your business, they are going to have a relationship with the 10 potential buyers out there, potentially a warm relationship, and they're going to be able to bring them to the table. Find out who the people are that know all the players and build a relationship early on, so that when it comes time, or if it comes time unexpectedly, you're able to bring qualified buyers to the table quickly.
Great advice. Towns?
I think that's really good advice, and in a more general sense, I think it's you know, build relationships. Talk to people before you need something from them. If you're just sitting around at night looking at the ceiling, thinking about what your business is worth, you've got no data. It's not informed by data. Relationships are where you get that data.
And they don't have to be paid relationships.
No.
Mentors, friends,
Right.
people who you take to lunch and say, tell me
Absolutely.
about your business.
Right.
Shirley, how are you managing this? That's a great way
Right.
to establish relationships and get
Right.
information that isn't costly to acquire.
I mean, I think the best, you know, build a great business, customer relationships, depth of team, brand, all those things are just part of building a great business. Cultivate relationships that'll give you information that'll enable you to be realistic. I think you want to be positioned where you never have to sell. You can sell when you're ready to sell. And that's the way you're going to maximize value.